We're here to talk about the Silicon Valley real estate market for the week ending April the 17th, presented Saturday morning, April the 18th. I have April the 19th on here because that's my annual comparison. I'm going to do a recap, and here's the first recap slide. Basically, the red over here indicates Silicon Valley is still moving very quickly. The green and blues over here indicate that the market is average to slightly slower than typical for this time of the year for Silicon Valley, which is still a fast market, as indicated by the red on the left. The big takeaways are we have 25% more surplus inventory than we normally do at this time of the year. We have a 20% shortage of offers. We have 20% more marketing times. Those times are still quick. For example, marketing times is 20 days. 20% longer than normal is still less than 3 weeks. And price reductions are double what they normally are, but they're 0.75%. Despite all that, we're getting 8.3% overbidding versus the typical 7.4%. So despite these numbers up here, which are all sort of a pessimistic marketplace, we're still having aggressive overbidding at 8.3% when normally we have 7.4%. So the buyers are still feeling the pressure. It's still a fast-paced marketplace. It's still just a little slower than it typically is. I would actually call it normal to slightly slower than normal. And prices are increasing as they typically do, and they're starting to roll over as they typically do. This is the summary slide. These are the chapters and roughly the time estimates on each major grouping. These are the individual chapters. Here's a QR code if you want the handout, which is up to 77 pages. And if you want to provide any suggestions, positive or negative, I'm very open to them. Here is just looking at the number of offers that are accepted. And this has not been updated for this last week. So this is a week old, so I won't spend a lot of time on it. But basically, you can see that each dotted line is where the 10-year median is for that week. This is 1 week of sales, 2 weeks of sales, 3 weeks of sales, 4 weeks of sales. So you can see we're down, but we can see we're following the normal pattern. Here is turnover time. That's how long it theoretically takes to sell the market one time. That's the bold purple line. You're 22, 23% more than you normally are. That means it's taking a little bit longer for the turnover time. How long would it take to sell out all your inventory at the existing rate of sales if no new inventory came on the marketplace? A theoretical number that will never be reached, but an indication of the supply-demand balance is basically what it is. Moving on to offers accepted, you can see that we're just barely above 80%. But 80% is where we've been basically since 2024. 2023 was at 70%. You have to go pre the 2022 price correction to have more offers accepted than typical. Even before the pandemic, we were basically right at the normal level of offers accepted. Since the pandemic, you had a surplus in offers for a while. Then you had the price correction. Ever since the price correction of 2022, we've had a significant shortage of offers accepted. There isn't a built-up inventory. The buyers and sellers are in balance, which is why the market is staying where it is. Here's the active inventory. You can see that we're basically at record high levels on a percentage basis. It's somewhere around 25% more inventory than we normally were. There was a little bit of period of time in 2025 when you had more, and a little bit of time back here right at the end of 2018 and the beginning of 2019 when you had more inventory. But buyers are having more selection than they typically do for Silicon Valley. Here are 7 key metrics. We're looking at a quarter. The purple line is the data. This current week is the middle line here. Going in the futures to give you the direction of where the market normally goes. Obviously, there's no way to predict what the market will do. It depends on world events to some degree, and inflation, interest rates, all those, unemployment, rate of change of unemployment. Anyway, you have the turnover time. A quarter ago, 13 weeks ago, it was 52 days. It's at 42 days. So this is a time of the year where it's normally improving, as you can see by the gray line, which is the typical. But we're 43% longer right now than we are typically. A quarter ago, we were only 12% longer. You're at 43 days. The longest you'd expect is 46.5 days. Quite a bit longer than it's almost 50% longer than the 30 days that is typical. That's typical's down here at 30 days. Slower than typical's up here at 46.5 days. We're sitting here at 43 days. Marketing time. This is how long it takes 3/4 of the sellers to sell. The reason I use 3/4 is about half the marketplace comes on the market and sells the first week. So they're really not an indication of the market being stronger or slower than it normally is. I'm only looking at the 50% that doesn't really sell that first week on the marketplace. They're currently taking 18 days. Typical is 17 days, so you're 3 days. But look at your longest is only 18.3 days. So it's only 1.3. We're going from the typical to the fastest is a range of 5. So it's not uniformly distributed always. This is the 90th percentile up here. This is the 50th percentile or the median. And this is the 10th percentile, the quickest time frame down here. That's how the numbers are determined. This is the numbers right here for today. It's 17% longer than it normally is at 20 days. Price reductions. This is the average. So it could either be more frequent or larger price reductions than we normally have. Right now, we're at 0.75% off the seller's ask price. This is what the seller does to their own ask price. Now, it's not sellers taking 0.75% reduction. It's a few sellers taking large 10% reductions that average out to this 0.75%. Typically, it's only 0.3. The largest, the price reductions is basically right where we're at. We're taking some of the largest price reductions that you'd expect, which is why you're right on the blue line. It's the biggest price reduction. So it would be the 90th percentile, but it's in the negative direction. Overbidding. What's overbidding doing? This now is just in raw percentages. Typical is 7.4. We're almost getting a full percent higher than that at 8.3% over their ask price. So if you're asking $1 million, you're getting $1,083,000. In a competitive marketplace, that would be as high as 12.4%. It's typically the 7.4 that I said, and in a slow marketplace, it's only 4.9%. Offers accepted, there are fewer offers being accepted than typical. We're at 81%. That's 2,175 transactions. Normal is 2,600. In a robust, heavy marketplace, you would be at 3,000. A sluggish marketplace would be down at 1,700. You're in between a typical marketplace and a sluggish marketplace, missing about 19% of the marketplace. Inventory, this is what the buyers have to pick from. You have 25% more inventory. We're at 2,665, approaching some of the largest inventory you'd expect at 2,750. And these numbers are for all of Silicon Valley, which is Alameda County, Santa Clara County, and San Mateo counties. And finally, closing out with transactions, which is really just a point of interest. It's really a lagging indicator because that's 3 to 5 to 6 weeks after the fact. We're hitting 87% of the transactions that you normally expect for this time of the year. Here is my chart. On the left-hand side is the raw count. So you can see that a lot of the indicators like reduction or price reduction frequency is really red, which means there's very few price reductions. The magnitude of the price reductions are pretty much normal. There's a few that are red, which would be less price reduction than normal. And in Alameda County, there's several that are blue, which is they're greater. And by greater, that's only 1.3%. So these are not huge price reductions. In fact, if I'm looking at this, 1.3 may be the largest price reduction, 1.4 up here in Saratoga, Los Gatos. Marketing time is all pretty quick for all of Silicon Valley. It's at 20 days. That's why these turnaround times, you come down to Foster City, it's in 7 days. You come up to Cupertino, it's in 13 days. Los Altos, Palo Alto, 14, 15 days. Turnover time is also equally fast. To sell out your entire inventory in a month in several areas is pretty long. There are a couple major exceptions to this, though. Look at out in Alameda County, look at Castro Valley, Dublin, and Livermore, 150 days. You know, that's approaching 5 months of inventory. Pleasanton area at 140 days. That's why it's important to look at micromarket data and not just overall countywide data. This middle green section is comparing to the 10-year median. Now you can see there's a lot of blue, which would be a slower, more favorable to the buyer marketplace. So turnover time, all longer. Look at this, 203%, 236%, 162%, 169%, overall 143%. What's the longest one I'm seeing? Foster City at 358, but that's a small micro market area, so let's discount that. So the next highest one is Santa Clara, Willow Glen, Campbell, and Cambrian at more than double, 2 1/3 times longer turnover rate than they normally are. What is that turnover rate? That turnover rate is 48 days. It's still a reasonable turnover time, but it's much slower than it typically is. Marketing time, 15% longer. One of the things that starts to convey to me is there might be some sellers that are coming on the marketplace not able to sell at all. That impacts the turnover time, but does not impact the marketing time, because the marketing time is the time to get an offer. And if they never get an offer, they don't come into that equation. Price reductions, nothing outrageous. The biggest one is Atherton, where they're taking 7.8% less price reductions than normal. Frequency of overbidding makes price reductions makes sense. Red, 55% in Cupertino. That means you're only having half the price reductions you normally do. But then you flip up right next door, or essentially next door, Santa Teresa, Blossom Valley, Milpitas is at 2.5 times the normal price reductions. This is the frequency. How common is it? This over here is the magnitude. Overbidding. How common is overbidding? The magnitude. Most of these are right around 100%, which means we're doing the same amount of overbidding as normal. There are a few areas that are 98%. And again, that's sort of the central part of Silicon Valley, Santa Clara County, but also go down into Alameda County where you have you actually have a 97. But almost look at this. You have 97% in Hayward, and then you jump up to Berkeley and Alameda, and you have a 9% more overbidding than you'd expect. Frequency of overbidding is the next column over. You basically green in color, so the frequency is about what you'd expect. But if you notice, almost all these numbers are less than 100%. The couple exceptions, again, Berkeley and Alameda, Foster City's a small area, Atherton, Menlo Park, and Saratoga, Las Gatas. One of the things I haven't said, I don't believe in this presentation yet, is the expensive areas seeming to be doing better than the more affordable areas. Offers accepted, basically you have to compare this to normal because there is no, each micro market area is a different size. Alameda County, I don't have micro market data, but 76%, so you're missing 25%. Santa Clara County is missing 80%. It ranges from 20% more than normal to 30% to 35% less than normal. Quite a range within a county. And active inventory, the only areas that are close to normal are the expensive areas. Las Gatas, Saratoga, Los Altos, Palo Alto, Atherton, Menlo Park. Everybody else has quite a bit more inventory, and by quite a bit, up in Santa Clara County, you know, you're 50%, maybe 150% more, 150% of the inventory you'd expect. Alameda County, no micro market data, is 13% more inventory than you'd expect. And this is the area of appreciation since 2015. Santa Clara County, the affordable areas have done the best rate of appreciation, as well as the affordable areas in, actually the more expensive areas in Alameda County, which are sort of the affordable areas of Santa Clara County. And then the expensive areas in San Mateo County have the highest appreciation. And then on pricing, this is simply which are the hottest price, and the highest price is the Menlo Park area. And I'll use that for an example. The lowest 10 percentile home you'd expect to find in Menlo Park, Atherton, is 2.6%. The typical is 5.6%. And the most expensive you'd find is almost $12 million. Here's some micro market data definitions. Here's the first micro market definition. These are the color steps that I put on. What you have going on, you have Silicon Valley first, then Santa Clara County, San Mateo County, and Alameda County, and their corresponding micro market underneath each one of them. Basically, red in color means the turnover rate is faster than normal. So Fremont's having a faster turnover time. What is it? It's 21 days. This is the Redwood City area in San Mateo County. It's turning over in 18 days. The Belmont area, the Bay Cities, is turning over in 25 days. So the faster the turnover time, the pinker or the redder the color is. If you come in here to the heart of Silicon Valley, you're sitting there at somewhere around 45 days, 40 days, something like that. The green should be between 42, just over 42 to 78. Is I go from 7 to 42 is the red in color, just over 42. So just the slightest amount of over 42. It jumps to green up to and including 78 is green. Just over 78 to the 145 is blue. 200 doesn't become some other color than blue. It's just a saturated blue. So saturated red at 7, saturated blue at 145. In between is graduated by these steps over here. Yellow green is on the hot side. A blue green is on the cool side. Green is exactly normal. Light blue is a buyer favoring the buyer a little bit. Dark blue is favoring the buyer a lot. Light red is favoring the seller a little bit, and dark red is favoring the seller a lot. Here's your turnover time. So turnover times are all greater than normal. The exceptions are some of the expensive areas. Los Altos, Palo Alto at 80% faster than normal, and Redwood City. And Redwood City is not really an expensive area, but it's not inexpensive. You know, it's more expensive than Santa Teresa, Blossom Valley, Milpitas, or South County, for example, or it's more expensive than Fremont. Here's marketing time. How quick is the marketing time? You can see for Silicon Valley overall, it's 20 days, which is still fairly reasonable. The longest is in Alameda County at 22 days. But, you know, look at these numbers, 15 days in some of the more expensive areas. And then you get into the more affordable areas and you're approaching 30 days. So there is a distribution within Santa Clara County on that based on price. In San Mateo County, it really doesn't appear to be on price because the Atherton is expensive at 22 days, and the Coast and Pacifica is the same at 20 and 22 days, or 22 and 20 days, and they're definitely more affordable. And in the middle, you have Redwood City, and they're the fastest. So in San Mateo County, it's sort of the more middle range prices that is doing the best as far as the turnover marketing time. The other thing I want to point out too is in Livermore and Pleasanton, we talked about their turnover time being around 150 days. I believe what the number was. Their time for 3 out of 4 sellers to sell is only 24 days and 26 days. So that's telling you that the sellers that are successful in selling are selling in under a month. So it's a lot of sellers. It's got to be a lot of sellers that are coming on the market and not selling, or it's holding on for a long period of time, finally doing a price reduction and selling. but they're the minority, even though they're taking that long to turn the market over one time. Here's the turnover time compared to normal. You can see Pleasanton is only double the marketing time. Both Livermore are double, which is pretty significant. I don't remember what Union City was. It's almost double the time like Livermore and Pleasanton, but I don't think it was anywhere close to 150 days. In Santa Clara County, you run from 100% of normal in Saratoga, Las Gatos to a high of 163% in Milpitas, Berryessa, Blossom Valley, and Santa Teresa. San Mateo County ranges from 56 days in Foster City. Even if I ignore that, 73% for the San Mateo County coast, smaller, a very small market. So if you don't have much of a range, you're really going from 103% for Redwood City to 133% for for Pacifica Daly City. Marketing time, Pleasanton and Dublin is almost double their marketing time. So is Union City, but the rest of it, Oakland's 150%, but Fremont's right at normal. Berkeley and Alameda is only 11% slower than normal. Here's price reductions. This is the average price reductions that the sellers are taking. 0.7% for Silicon Valley, 0.7 for Santa Clara County. San Mateo County is taking half that at 0.4%. That's less than half of 1%. And Alameda County is taking more at almost a full percent price reduction. This is the price reductions versus typical. So where are they taking more price reductions and where are they taking less? And again, I'm not sure I want to comment on this slide too much because as I sit here right now, I would say that 103% would be 3% more price reductions, which would not be good. But when you have 92%, which I would think would be good, less price reductions, I'm coloring it blue. So I think my colors are inverse. This is the frequency of price reductions, where you have 8% price reductions. You have bright red, 3% is solid red because I go all the way down to 5% before I hit saturated red. So Santa Clara County has very few price reductions. This is not compared to normal. And the area that's having the largest price reductions is South County at 25% of the sellers. Foster City is black in color because you have a divide by zero when you have no price reductions, which is an undefined algorithm. Frequency of price reductions, very small frequency. The biggest one I'm seeing is in San Mateo County coast at 13%. You come down to Atherton, less than 2% of the sellers are doing a price reduction. You go to Pacifica, 7.5%, Belmont, 7.5%, Redwood City, 10%, Foster City, no sellers took a price reduction. And in Alameda County, even in those areas where we're talking about Livermore and Pleasanton with the huge turnover rate, only 15 and 17% of those sellers are doing a price reduction, which may be explaining why the turnover time is so long. They come on the marketplace, the market isn't willing to pay that price, they give up and never sell. So they are impacting the turnover time, but they don't negatively impact the marketing time. I suspect, and I don't have data to back this up, that part of what's going on in those areas is you had a fair number of people at the peak of remote working go out and buy in those areas because they were more affordable. And now that they might have to be going back to work more frequently, are trying to sell. And because they just bought at the peak of the marketplace and because prices have been flat for the last 4 years, they don't have the flexibility of lowering their sale price without losing money. And there's a huge resistance for sellers to lose money in a real estate transaction. They buckle down and they put up with the commute for a couple more years over losing money. Here's the frequency of those price reductions. You can see they're more frequent overall. San Mateo County, though, is right on normal. Pacificus gets the most price reductions versus typical. They're 50% more price reductions than they normally have. Livermore and Pleasanton, they are having more than they typically do at 70% more and 130% more. Look at Union City, almost triple, almost quadruple their price reductions. So that's where there's a lot of price reductions going on, is within Union City and Newark. Here's the average overbid. So how much are the buyers overbidding in order to try to get the property? Anywhere from 0.9%, which is sort of the typical balanced marketplace, all the way up to 10.8% in Santa Clara County. In San Mateo County, they're actually taking price reductions at the time the offer comes in the door of 0.2% up to a 10% price increase. Alameda County, Alameda and Livermore and Pleasanton is small price increases at 1.6 and 3%. So that's happening even though they have the long marketing times. But come down and look at Berkeley and Alameda and even Oakland. 17% overbidding in Oakland, 27% overbid in Berkeley and Alameda. That means if you're asking $2 million, well, $1 million for your home, it's turning around and selling for $1.25 million. That's huge. Here's overbidding versus typical. So mostly green in color, which is pretty much close to normal. You can see for Silicon Valley, it's 1% more overbidding than normal. Santa Clara County is 4/10 lower. San Mateo County is 3/10 higher. And Alameda County is where the overbidding is happening, believe it or not, is at 3% higher. It's got to be brought up by Oakland and Berkeley and Alameda because they're the only two micro market areas in Alameda County that are over 100%. So they're bringing up the rest of the county. Here's the frequency of overbidding, just how common is overbidding. 70% in Silicon Valley, 70% in Santa Clara County, 70% in San Mateo County, and 73% in Alameda County, with 86% of the offers in Berkeley and Alameda County are going, Berkeley and Alameda Island are going over the seller's ask price. I don't understand why sellers in those areas just don't raise their price based on what's happening with buyers. But congratulations to them. They've been the hottest areas for quite a while. And I don't work that area, so I don't really have any professional insight on why they're doing so well. Here's the frequency of overbidding. Basically, you can see you're a little bit below normal. You're at 97%, 96 for two of the counties, 97 for Santa Clara County. You got a low of Milpitas, Berryessa, Santa Teresa, Blossom Valley at 85% to a high of 109% in Saratoga, Los Gatos. And just the range of these numbers shows you why it's important to look at what's happening in your micro market area, which is why I sort of chuckle when the media talks about so authoritatively about what's happening in the Bay Area real estate marketplace. And they talk about one number, the 9 counties that touch the Bay. And I have that later in the presentation at the very end. But you can see within each county how widely different the micro markets are. In San Mateo County, you go anywhere from a 54% of what they normally are on the coast, so a lot less activity there, to 112% in Foster City, 12% more overbidding. The frequency of overbidding is 12% higher than it normally is. So if it's at 50%, it would be at 56% now, 12% of what's typical. In Alameda County, it ranges from, I think, a low of 75% to a high of 106%. So the overbidding, the high amount of overbidding that we're seeing in Oakland, Berkeley, and the island of Alameda is exactly normal. So they've been doing that typically for the last 10 years. Offers accepted, you can see across the board we're down, except for San Mateo County. It's at 100%. It's absolutely normal. Where does it stand out? The Bay cities, the more affordable areas on this side of the Bay, the reasonable commutes. Why? I think what happened again is all related to remote working. I think the buyers weren't willing to pay the premium for San Mateo County when the remote working was very common. And now that it's not, they're coming back in and bringing up and making more offers than they normally do. So they fled the area for the first 2-3 years after the pandemic. Now that we're 4 or 5 years after the pandemic, they're coming back in as normalization is starting to slowly return. I don't think we're going to ever get back to no remote working, essentially like we did before the pandemic, but the amount of it, I believe, is reduced. Here's the active inventory compared to normal. You can see that we have more inventory overall, 25% in Silicon Valley, almost 40% extra in Santa Clara County, 30% extra in San Mateo County, and only 13% extra in Alameda County. You can see there's quite a bit of range in each county. Santa Clara County goes from basically normal, 5% missing at 94, 95% here, to a surplus of 70%. So you got a range within the county of 75%, which is pretty significant. If your range is 100% and you got a 75% range within that 100%, that's pretty huge. Obviously, you can triple, you can't go lower than 0% of your normal sales. Here's the areas of appreciation, sort of the affordable areas in Santa Clara County have had the highest appreciation. You can see right here geographically where the most appreciation's been. The least appreciation is in the blue areas, and the green is sort of the normal. And since these are just, some areas have to be more, some areas have to be less because you have the normal range. And then on pricing, it's simply where the more expensive homes are and where the more affordable homes are. So you can see that the San Leandro area is one of the most affordable areas. Their median price is less than Oakland. Their median price is only $960,000 versus Oakland's is essentially $100,000 higher or 10% higher. The 3 numbers on here, the left-hand number is the 10%, the cheapest you'd expect in the area. The middle number is the median, and the right-hand number is the most expensive, 90% that you'd expect to find in that geographical area. Here's the summary slide that we started off with at the beginning. Here is how you participate, etc. To get the handout, you can hit this QR code. It is up to 77 pages. Let me know if there's any additions or any subtractions. It's electrons, so you can download it for free and look at it, print, and if you want to just view them on your screen. To join the meeting live Saturday morning at 9 o'clock, you hit the QR code here or type in either the green root URL here and the year 2026 or the blue Zoom link. Come right in, and the password is right here at the end or up here for those that aren't URL readers. And if you want to go to the YouTube channel archive to see a past episode, you can hit the QR code on the lower left. You can go to the green root URL, or you can go to the blue YouTube link here. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley in single agency transactions. Here's some customization work that we can do. Basically, I try to work with the client's needs, what is important to them, the orientation of the house, the distance, the time, the schools, whatever's important to you. I can send to you all information that's not on the MLS typically data or on the internet, customized for your needs. Here's some definitions going on to the next set of data. Here, what we're doing now is we're comparing the data, the purple line, to the typical range based on the past 10 years. That's why I go back for 10 and a half years. The half year is the current year. This is the 10th year, last year, and then 9 years on the condensed scale. The most recent past year is at the same scale as the current year, so you can see trends better. This isn't condensed, so I can have all 10 years. I just thought it would be useful for consumers to see all 10 years. What I could do is drop off data and just leave the 10-year median on there. But if I'm using data, I thought I would share it all with you. That's how I pick it. If anyone wants to give me feedback one way or the other, that's fine. You can see that right now turnover time is climbing. It typically climbs at this time of the year. It's a little bit less than the 90 percentile or the longest turnover time. It's quite a bit longer than you'd expect. You can see the change started to happen midway through first quarter. We were following the pretty typical pattern here, except the difference between the typical pattern and the blue line isn't very significant. So were we basically following the blue line the whole time? That's starting to look like what went on. What you might argue is we were sort of following the blue line ever since sometime around 2025, and exceeding the blue line. And then we improved right at the last quarter and a half of 2025. And then we returned back up to the blue line for 2026. Here's a turnover time compared to normal. What this is doing is if you're having a typical year, you'd be right down here on the gray line. Here you can see you're favoring the buyers quite a bit, and you're having 43% more slower turnover time than you typically do compared to the 10-year median for this week. And I can explain my weeks right at the very end of the video if you're curious on that, which is why I have April the 19th on the data slide, not April the 18th, which is obviously the day I'm presenting this. Here's marketing time versus typical. So this is that three-quarter seller. You can see we definitely turn and we're climbing, but we're still only at 20 days. Look at this. Silicon Valley in the last 10 years has never gone over 60 days because the purple is the actual data. So no time in the past 10 years has it taken the typical seller even 2 months to sell their property. The reason I'm stressing that is a lot of places in the country talk about 4 to 9 months being typical marketing time. Silicon Valley is in a world of its own. This is on an annual basis, so where you compare to what percentage, you can see you're about 18% longer than you'd expect. You can basically see ever since the price correction, we've been spending more time above the 100% line than we have been below the 100% line. But overall, you'd expect it to be equal. And, I guess it is fairly equal. Here's the largest price reduction. This is a slide that I personally like. It's one of the sellers that are taking the very, very largest price reductions that are not statistical fluctuations and flukes and data entry errors. So the sellers that are taking serious price reductions are taking somewhere around 10.25% price reduction. If you have the typical single family home, because this data only covers single family homes at $2 million, and you're taking a 10% price reduction, that's a $200,000 price reduction. So they're not insignificant numbers. You can see that even in a hot marketplace, the sellers that are taking those extreme price reductions are taking a 6% reduction. So that $2 million seller is taking $120,000. The only time it was less than 6% was a very brief period right before the peak of the marketplace, right going into the peak, which was basically Valentine's Day of 2022. This is a little bit past the February 14th, Valentine's Day of 2022, which I believe, for a lot of reasons, was the peak of the marketplace. Here's the average. This is price reduction. This is the average to show you that I'm not playing games. That 10% price reduction that some sellers are taking translates to less, just about 0.7%, maybe 0.75% price reduction, because so many sellers are not doing a price reduction. But you can see how dramatically different those are, which is why, 0.75 of a price reduction, you don't even think is any big deal. But when you start seeing that the sellers that are actually doing the price reductions are taking 10% price reductions, that paints, in my opinion, a different picture. Here's the average compared to normal. So you can see we're now starting to improve and take less price reductions. So that's an interesting trend. Here's the frequency. So how common are price reductions? You can see that only 11.5% of the sellers are doing the price reductions. That means almost 88.5% of the sellers are doing no price reduction whatsoever, which is why that 10% jumps down to 0.75%. Here's the frequency of price reductions. It's 20% more, almost 30% more than normal. So frequency of price reductions is definitely more than typical. Median overbidding, I believe this is the only slide where I talk about the median. We are at 4.5%. So half the buyers are paying more than 4.5% over the seller's ask price, half are paying less. Note the turnover that occurred basically the first week after April the 1st. April the 1st is the first vertical line. For the last 1-2 weeks, we've clearly turned and have coming down on the amount of overbidding on a median basis, and I believe the average has done the same. Here is the average overbidding. You can see the average overbidding is less than 1%. It's 0.9%. This is raw magnitude. I believe the numbers were the typical overbidding was 7.4%, and the current overbidding is 8.3. 8.3 is 0.9% higher than the 7.4. So for this particular week, 7.4 would be the gray line. The actual data was 8.3. That's 0.9% higher than the 7.4, which is why the purple line is on the 0.9% above. Here's the frequency of overbidding. So how common is actually the overbidding? It's basically right at 70%, just over 70% of the sellers getting an overbid. 7 out of 10, almost at 75%, more than 2/3 of the sellers are getting more than their ask price when the offer comes in the door. Here's the frequency compared to normal. Even though almost 3/4, 7 out of 10 sellers are getting more than their asking price, that is less than normal. That's only about 98% of the frequency that you normally expect. Here's the offers are being accepted. You can see the markets turn around and come down a little bit, but note the cool marketplaces come down, the high end of marketplace turns around, and even the typical marketplace turns around a little bit. I think what's going on here is Easter negatively impacts real estate. Easter moves up to 5 weeks, 35 days. We're including Easter in our data now, and I believe that's what this slide here is. The years Easter was early were lower years. The years Easter was later years. Easter was sort of early it's in the early range of what it typically is. Easter's sort of a weird holiday. It moves about 3 weeks fairly frequently, and then there's a week on each extreme that it uses occasionally. So you were in that early part of the typical week. Oh, I should do an Easter distribution slide. That'd be interesting to look at. Here's your active inventory. Buyers are having more choice. You can see all 3 lines are climbing at this time of year, as is the purple line, which is the data line. You can see we started off the year with normal inventory, but basically halfway through first quarter, you started getting extra inventory, and we're still having that extra inventory. Here's appreciation. This is a relatively new chart. The red is the 10 percentile. So the 10 percentile price, the more affordable prices, have been underperforming in recent years. Basically, since halfway through 2024, it broke out and is underperforming the median and the high home. And very recently, the gray line is outperforming the 50. So the orange line is your median. That's what the typical home is doing. The gray line, the very high, is getting slightly higher appreciation, and the more affordable areas is way under. You can see that before the pandemic, all 3 lines were fairly close together. And even for quite a while after the pandemic, as I said, it really wasn't until halfway through 2024 that the blue line fell out. And it's hard to tell if this gray-orange separation is an anomaly or a new trend. Will the separation tend to continue? I would agree that the high-end marketplace is doing better than the typical marketplace for whatever reason. Here's prices, and now I'm doing my price model on 3 different things, and you can sort of see it here. The high-end prices are continuing to climb where the median price is flat and the affordable area price is flat. You know, there's something to be said about this. Your Saratoga, Las Gatos, your Los Altos, Palo Alto areas are doing better than your Santa Clara areas. Here's the monthly payments. It's going to be the same order. It just takes into consideration the interest rate. And I do use high balance conforming loan limits, which is a sort of a misnomer for Santa Clara County because almost everybody uses jumbo money that does a loan. I'm also doing an 80% loan, which isn't that common. And a lot of people that are able to purchase homes have stock portfolios that give them relationship pricing as long as they use the lender that their stock portfolio is associated with. Here's some information. This is moving on to comparing the three counties. So here, Santa Clara County is in the blue. Alameda County, the second big dog, is in the gray, and San Mateo County is the smallest county of the three. This is just showing the turnover time. So San Mateo County is clearly selling the quickest, followed by Santa Clara, and Alameda County have the longest time. And that's been, again, since 2025, Alameda County has been the slowest. You can see the gray line has been above the other two lines. Here's time to sell. This is the 3/4 of the sellers. Again, San Mateo County peaking out here is the fastest, followed by Santa Clara County and Alameda County being the slowest. But when I'm saying the slowest, that's 22 days for 3 out of 4 sellers to sell. That means only 25% of the sellers are not selling in 3 weeks. This is average price reductions. Alameda County is taking the biggest price reduction of almost a full percent, followed by Santa Clara County around 2/3 of 1%. And then San Mateo County is doing the least amount of price reduction at less than 0.5% price reduction. And that's average. So with the sellers that are taking those price reductions is going to be a completely different picture. Frequency of price reductions. Here, Alameda County, again, is the slowest or the highest at somewhere around 13%, followed very closely by Santa Clara at 12%. San Mateo County is not really participating in price reductions with only 8% of the sellers doing a price reductions. That's like 1 in 12 sellers reduces their price at all. You know, it could be $1,000. Average overbid. Alameda County, despite the long marketing times, has the most overbidding. That suggests to me that the buyers are coming in, sellers finally reduce their ask price, the buyers are coming in. And you can see that pattern basically since 2025. Alameda County has been outperforming in overbiddings. It's been underperforming in other things, but outperforming in the overbidding with long marketing times, which is not what you typically expect, which is part of the reason I go into so much depth in this presentation, is so that you can grasp that not every data side goes where you would intuitively think. Typically, you would think with long marketing times, you would think overbidding would be non-existent. If you're a buyer and you're trying to buy in Alameda County under that impression, where you have this 12% overbid, you might lose out on the house that you're really looking for. So it's important to understand what's happening in your area, and you should look at enough homes that you're comfortable knowing what you're comfortable doing without relying on any data. Stats is a way to give you a grasp of an overview, then you go out and experience it. San Mateo County is next at 8% overbidding, and Santa Clara County has the least amount of overbidding at 6%. Here's the frequency of overbidding. This is one number where they're all very close together, basically 7 out of 10 sellers, basically from 70 to 73% for all 3 counties. You can see San Mateo County is at 70, Santa Clara County is at about 71, and Alameda County is about 73% of the sellers are getting overbid. Offers accepted, you can see that it's basically going down. And again, I believe that's because all 3 counties would have Easter in them. We're past Easter. So until we get 5 weeks past Easter, we're going to have a downward trend. Then we're going to probably go up, and this number will go back up. Also, just it's been a while since I pointed out, I look at offers, not pending transactions. A lot of people report pending transactions. People that we use pending are offers that are currently in escrow. So a cash transaction that closes in a week would have less impact on the data than a difficult loan that's in escrow for 10 weeks. One organization, I don't remember which one it is, it has come up with a new coin talking about pended, and that's the week that they go pended. My offers accepted, look at offers accepted for the past 5 weeks, basically a little over a month to get the same number of days of the week all the time. And if the deal falls out, the transaction fails out of escrow during that 5-week period of time, I reverse it from that point going forward. I don't go back in time and reverse it out, but from that time frame going forward, I do. But I also update my data. So when it falls out, the data does get updated. So it's sort of a hybrid. and it impacts some data that doesn't get updated, like days on market. You're not going to go back and update that, but marketing time you do. So you got to pay attention. And my goal is, this was developed back by myself in '97 and has been added on to over the years, and significantly since the pandemic. I did it when I was buying trustee sales. I needed to be able to come up with a reasonable, accurate way of determining market value quickly on the courthouse steps when a property came up for auction. I couldn't rely on the median price of the county, which is what the MLS produced. So I came up with the micro market data, and it worked really well for me. And then people started bugging me and calling me and asking me about things, so I went public with my data. Here's active inventory. You can see that all three counties are climbing. Santa Clara County has the most active inventory at almost 11,050 homes. Alameda County is at 1,050, and San Mateo County much smaller at about 475 homes on the marketplace. Here's the appreciation. Santa Clara County has the most appreciation, and I think I can point out later on why that is. Alameda's got the least at 80%, and San Mateo is in between at about 92% appreciation, and that's since the last 9 months of 2015. Here's the median price. San Mateo County is the most expensive county, followed by Santa Clara, followed by Alameda. And the actual numbers are San Mateo County is at 2.2 million, Santa Clara County is at 2,050,000, and Alameda County is about 1,340. Here's the payments going through that same mathematical formula, assuming an 80% loan and high balance conforming loan limits. Here's an interesting slide. Pay attention to some of these numbers. The 2175, yeah, that's the sixth best, which is basically in the middle of the market. But look at how close it is to 2165. And I'm also, the data doesn't ignore the pandemic at 1,200. So to me, it's really the sixth best year out of the last 9. And then it's really gonna, this number here is gonna decrease, and it will probably decrease to the point where it'll go under the 2165, and it may decrease and go under the 2118. That's a little catchy. It may or may not quite make it there, but at least it's close to it. So it may actually be the second worst year out of the last 25 years, excluding the pandemic. So you got to take these numbers with a grain of salt when you have data that were impacted by the pandemic back in 2020. And this is 2019 because I'm going back to October of the year before. Once the 2026 data rolls up to the top slide here, then these numbers change. So you got to be a little careful. It makes sense to me, and it may not at first blush to everybody else, but even if you come back up here and look 2045, 1952, it's only off by 5%, so you're close. That's why I put in the percent of median. So we're only at 90% of median. That's better than 80% that we were up here, but it's still not a huge, and you're part of the reason this number here now is climbing so high is the low number of transactions is plummeting because of COVID. Here's the raw data for Santa Clara, San Mateo, Alameda, and or Silicon Valley, each one of the metrics, so you can actually see the raw numbers for yourself. I have 2 levels of appreciation, the level since 2015, and then I also have the green is since 2025. The black line up here where the cursor currently is 2015. So you can see since the pandemic, Santa Clara County has really shined. San Mateo and Alameda County are basically right around 35% appreciation, where Santa Clara County is at almost 50% appreciation. So 15% higher. That's almost 50% more appreciation in the last 6 years. If you're in Santa Clara County and own real estate, congratulations. Here's the key definitions for the distributions that are coming on. Here's marketing time. You're going all the way down to the 50 percentile, and the reason you stop is the data gets very condensed down here. You're going all the way up to 90%. Let's step through. You're looking at the marching dotted lines. You're climbing, so you're slowing down. So I'd expect longer and longer marketing times in 2026, just like we got in 2025. Now, at some point coming up pretty soon, like probably right here, that's the peak of the marketplace. Now you're actually in August, you're actually accelerating down and improving. See that improvement? And that's probably about the bottom. And so now in the middle of October, you're going to reverse and start going back up and slowing down for the end of the year. And on January the 3rd, right there, that's the slowest for the year. And then you're going to start accelerating going into 2026. This was earlier this year. Now you're almost approaching this. That's the bottom, the fastest on March the 1st, I think, March the 1st. and now you're rapidly approaching, I think next week, right there is this week. So what's that mean? That means you're going to be seeing longer marketing times until sometime around August. Then you'll see a slight improvement until middle of October, and then you'll see a decrease. This is sort of foreshadowing what the market is likely to do with no major upsets to the marketplace. Same concept with the largest price reductions. The purple line is current data. Right underneath, you can see the dotted line there and here. That's where we were last year. So the price reduction from this year to last year is a 100% match. You can see that you're getting more larger and larger price reductions. So I'd expect the same thing in 2026 that we saw in 2025. Now you're getting that July timeframe. So coming up probably right there is probably, okay, maybe right here in August. It's every other week. So July, end of August, end of July, beginning of August was sort of the bottom of the marketplace. Now you're accelerating all the way through October 11th. And now starting on October 11th, you're going to start cooling down again. So the same thing that we saw in marketing time, the same pattern. And now you're going to be having the bottom of the marketplace right there on January the 3rd. And then you're going to have dramatically lower price reductions going in. And right coming up there is March the 1st, which again corresponding with the days on market, is the least amount of price reductions, the fastest marketing time. And now you're slowing down. So what I expect? I'd expect the market to continue to slow down until basically that July timeframe. Then I'd expect a slight improvement through the middle of October, where I'd expect it to then have more and more price reductions until we hit January the 3rd. And then I would expect a rapid reduction in the price reductions. And finally, the same concept with overbidding. You can see the dotted line is a little more separated. Here you had a little bit more overbidding last year, but on the very high end, you're having more overbidding this year than you did last year. So it's not even consistent. And over here at the very low end, you had a little bit more underbidding last year than you did this year. So the market on the extremes was more negative last year than it is this year. But the other major thing to keep in mind is this is sale price, is overbidding, so it's dependent on sale price. So it's going to be lagging by 4 to 6 weeks behind the market trends. So the dates that we saw in the previous two distribution slides will be 4 to 6 weeks later on this distribution slide. Let's go through and see that. You can see that the overbidding has been basically decreasing last year, so that's what you'd expect going into this year. And the bottom was going to probably be later than the middle of July, because that's where it was on the other two metrics. That might be it right there on August 30th. So that's at 6 weeks later. Now you can see you had a slight improvement in the marketplace, and it will cover longer than the middle of October, probably right there at the beginning of November 8th. And now it's going to drift down to the end of the year. And instead of being on January the 3rd right there, it's going to go down a little bit more and be the bottom there on January 31st, 4 weeks difference. And that's because the market's faster pace. So buyers do quicker escrows. Then you rapidly have overbidding coming up to the peak right there, probably on April the 5th. And now you're going to be going down and cooling off. So we're already past the peak overbidding on closed transactions. So we're way past the peak overbidding on buyers' offers. Here now is the Greater Bay Area, 13 counties and 5 regions. Here's the 5 regions: Silicon Valley in the purple, the cities, San Francisco and Marin in the orange, Central Valley in the yellow, North Bay in the gray, and Central Coast in the blue. This is turnover time. You can see Central Coast has the longest at 80 days. San Francisco has the fastest at 35 days, and Silicon Valley is in between at about 43 days. Here's time to sell. Silicon Valley and the cities are very close together at 20 days. 3 out of 4 sellers are selling in 20, 21 days in those 2 regions. The other 3 regions are up here in the range of 37 to 43 days. Close together, but significantly double the time that it takes the 2 counties, the regions down here. So when you put all these in a Bay Area, and granted, the Central Coast and the Central Valley are not part of the Bay cities, so you eliminate 2 of those, but North Bay is definitely part of the Bay Area. But average this gray line and these 2 lines, totally different world place, totally different. Average price reductions, you can see again, Silicon Valley and the cities are very close together at about 2/3 of 1% price reduction. Then you go to the Central Valley at just over 1%. Then you go to the North Bay at 1.1%. And then you finally end up at Central Coast, which is at 1.9% or 1.8%. And I think I need to come back and correct this. The cities and Silicon Valley is at about 3/4 of 1% price reduction on average. Here's the frequency of price reductions. Again, the two that are doing way better is cities at about 9% of the sellers doing a price reduction. Silicon Valley at about 12% of the sellers doing price reductions. And again, you have the other regions that are fairly close together. The North Bay and the Central Coast are very close together at 22 days. And the Central Valley is the one that's taking the longest time, and over 25% of the sellers are doing a price reduction. So 1 in 4 sellers are doing a price reduction. 1 in 5 sellers are doing a price reduction here, and 1 in 10 are doing a price reduction for the cities in San Francisco. Here's overbidding. Cities is by far the most overbidding at 16%. Earlier, we were talking about Silicon Valley, and it was only at 8% overbidding. I think it's 8.3%. But then you come down to the North Bay, and it's at 1% overbidding. Central Valley is right at ask price, and that's an increase. It had been taking price reductions when the offer comes in, and the Central Coast is still taking about 0.5% price reduction when the offer comes in the door. Frequency of overbidding, again, you have two regions, cities and Silicon Valley, exceeding 70% of the sellers getting more than their ask price, followed by the North Bay at about 44%, followed by the Central Valley at 42%, and even Santa Cruz, where they're taking a price reduction overall, still more than a third, 35% of the 34% probably of the sellers are getting more than their ask price. Offers accepted. Here, this is going to be based on size. Silicon Valley has the most offers, so it's in a way the data the most. Then the North Bay, then the Central Valley. The cities that's doing well, like Silicon Valley, is a fairly small geographical and population size, and it's down here at somewhere around 575, 580 offers accepted. And the Central Coast has the least at about 350 offers accepted. Here's active inventory. North Bay's got the most active inventory, followed by the Central Valley. So they have way more inventory than Silicon Valley, but Silicon Valley had more offers. Then you have Silicon Valley, and then the least amount of inventory is Central Coast and the cities. So the cities is outperforming the Central Coast, as we knew, because it had less inventory and more sales. And here's the long-term appreciation. Silicon Valley has the most appreciation. Central Valley is second, then the Central Coast, and tied for last place at 70% appreciation is the cities and the North Bay. Here's the pricing. You can see that we're basically at the not quite. Silicon Valley is actually, look at that. Silicon Valley is at its peak pricing from 2022. And that's the only one that is. So congratulations to Silicon Valley. Cities is slightly below their peak pricing. The Central Coast is below their peak pricing. North Bay is below their peak pricing, and so is the Central Valley below their peak pricing. So only Silicon Valley is above their peak pricing. Here's estimated payments, again, using the high balance conforming national average, 80% loans, and you can do better than that. But you can see how flat the payments have been, say, in the Central Valley and in the North Bay. And you can also see the huge sine wave that goes through Silicon Valley. It fluctuates quite a bit. And the goal is obviously, if you're a buyer, to buy at the bottom and sell at the top. And if you're a seller, you're trying to sell at the top, and that's tough to do. Here is the raw data for it. The now column is the current week, the change from a week ago, and it changed from 5 weeks ago. And here's my weekly data. Basically, I start off on March the 1st, even though that's the 9th week. And I do that because there's leap year. So I start off on March the 1st, and I go back 35 days, which is February 28th to January the 25th. But on leap year, which is the yellow year, I would start on the 29th leap day and only go back to January 26th, because I only want 35 days to keep the cycle the same. So these 5 weeks are the 5 weeks that are different. Every other week is the same, but then I come back and renumber my weeks starting on January the 3rd, which covers the period of time from January the 2nd back to November 29th as my first week of the fiscal real estate fiscal year. And this makes up the 13 weeks of winter quarter, spring quarter, summer quarter, fall quarter. And then the other thing that you should notice is every jump from week to week is 7 days, except for going from the 21st of February to the 1st of March is 8 days in a regular year and 9 days in a leap year. And that's how I take care of the discontinuity. With that, we're back to the beginning. So we've been talking about the Silicon Valley real estate market. I appreciate likes and subscriptions. I'm Richard Calhoun with Creekside Realty, working with buyers or sellers. You can scan these QR codes. This gives you the 77-page handout. This lets you join the Saturday morning live presentation at 9 a.m. And this lets you get back to the archive. Not seeing any unmuted mics. Take care. Thanks for joining. Bye for now.